One $50,000 Roth conversion just cost you $15,000 in taxes, and most high earners don't see it coming. Welcome back to Tax Shield Research Team. Today we're breaking down the pro-rata rule, the IRS mechanism that's destroying Roth conversion strategies for high-income households. This is research-based analysis from Treasury Regulations, IRS publications, and court rulings, not personal experience, not advisor pitches. Just the tax code explained. Let's start with the trap itself. Imagine a household earning $250,000 annually. Both spouses are self-employed. They want to execute a backdoor Roth conversion, a strategy that on paper looks clean. Contribute $7,000 to a traditional IRA, immediately convert it to a Roth IRA, and dodge the income limits that normally prevent high earners from funding Roth accounts directly. On the surface, this strategy makes perfect sense. The IRS allows anyone, regardless of income, to contribute to a traditional IRA, and anyone can convert a traditional IRA to a Roth. So why can't you just convert right away with zero tax consequences? The answer is the pro-rata rule, codified in Internal Revenue Code Section 408D-2 and detailed in Treasury Regulation 1-408-4. This rule exists because the IRS noticed that people were using backdoor conversions to circumvent income restrictions. So in 1984, they implemented a mechanism that treats all your IRAs as one giant pool for tax purposes. Here's how it works in practice. Let's say you have $100,000 in pre-tax IRA balances sitting in existing accounts, maybe from an old SEP IRA, a simple IRA from a previous employer, or rollover contributions from a 401k. Now you want to contribute $7,000 to a non-deductible traditional IRA and immediately convert it to Roth. Under the pro-rata rule, the IRS doesn't see this as converting a $7,000 non-deductible contribution. Instead, it sees you as converting $7,000 out of a total IRA balance of $107,000. So 93.4% of that conversion is taxable. That means on a $7,000 conversion, you owe taxes on approximately $6,538. At a 37% federal tax bracket, where many high earners sit, that's roughly $2,419 in federal taxes alone, plus state taxes, plus net investment income tax if you're above $200,000 income threshold. But the real trap happens at larger scale. Consider this case study. A business owner with $2.5 million in annual revenue decides to execute a $50,000 backdoor Roth conversion. She has $300,000 in pre-tax IRA balances from previous rollovers. Using the pro-rata calculation, total IRA balance, $300,000 conversion amount, $50,000 pre-tax percentage, $300,000 divided by $350,000 equals 85. 7% taxable amount, $50,000 times 85. 7% equals $42,857 at a combined federal and state tax rate of 45%, not unusual for top earners in high-tax states like California or New York. This creates a $19,285 tax bill on a $50,000 conversion. That's a 38.6% effective tax rate on the conversion itself, far higher than the standard capital gains rates or long-term investment returns these individuals could achieve elsewhere. This is where most financial advisors drop the ball. According to a 2022 survey by the American College of Financial Services, only 52% of financial advisors correctly identified how the pro-rata rule would affect a hypothetical client scenario. That means roughly half of the advice being given on Roth conversions is incomplete at best and dangerously wrong at worst. Many advisors focus exclusively on the benefits of a backdoor Roth, the tax-free growth, the no required minimum distributions, the ability to pass untaxed wealth to heirs, but they neglect to ask clients whether they have any pre-tax IRA balances. This oversight costs families hundreds of thousands of dollars. Let's walk through the mechanism in more detail. When you file your tax return after a Roth conversion, you report it on Form 8606, Non-Deductible IRAs. This form requires you to disclose 1. Your total IRA balances as of December 31st of the conversion year. 2. The amount you converted. 3. The basis, non-deductible contributions. In your IRAs, the IRS then calculates the pro-rata percentage using all IRAs held by you or your spouse. This includes traditional ERAs, SEP ERAs, simple ERAs, rollover IRAs from previous employers, spousal IRAs. Importantly, this does not include 401(k)s, 403(b)s, or other qualified plans. This is crucial because it creates a potential workaround, but we'll get to that. Let's examine another real-world scenario. A married couple, both age 45, with combined income of $400,000. The husband has a $150,000 SEP IRA from his consulting business. The wife has a $75,000 traditional IRA from a previous 401(k) rollover. Their plan was to each do a $7,000 backdoor Roth conversion. Under the pro-rata rule, combined IRA balance, $225,000 total conversion amount, $14,000 pre-tax percentage, $225,000 divided by $239,000 equals 94. 1% taxable amount, $14,000 times 94. 1% equals $13,174 at a 35% effective tax rate. That's $4,611 in taxes on what looked like a tax-free strategy. The actual return on the Roth accounts would need to exceed 31% annually for the tax cost to be justified by the backdoor Roth conversion itself. Now let's address the counterarguments and nuances that advisors often raise. Some argue that the pro-rata rule only applies if you're actively trying to avoid it. This is incorrect. According to Treasury Regulation 1-408-4C, the pro-rata rule applies automatically, regardless of intent. The IRS doesn't care whether you knew about it. They calculate the ratio based on December 31st balances. Others claim that you can avoid the pro-rata rule by converting only the non-deductible portion first. This is also incorrect. The order of conversion doesn't matter under Section 408(d)(2). The IRS uses the weighted average of all IRA balances, not the actual account you withdrew from. A third argument, just don't report it on Form 8606, and it won't matter. This is tax evasion and carries penalties of 75% of the underpaid tax, plus criminal liability if prosecuted. The IRS has specifically targeted Roth conversion issues in recent audits, with the Treasury Inspector General reporting in 2023 that improper Roth conversions were a high-priority audit area. So what's the actual workaround? For many high earners, the solution is the qualified plan aggregation exception. If you have a 401(k) or similar qualified plan, you can roll your SEP IRA or traditional IRA into the plan. Once it's in the qualified plan, it doesn't count toward the pro-rata calculation. Here's how this works. Before executing a backdoor Roth conversion, you roll your $300,000 traditional IRA into your company's 401(k). Your 401(k) plan must allow in-service rollovers, many do but not all. You then have zero IRA balances. Now when you contribute $7,000 to a new traditional IRA and immediately convert it, 100% of the conversion is non-taxable. But this only works if 1. Your employer's 401(k) plan allows in-service rollovers. 2. You have a 401(k). Self-employed people can use solo 401(k)s. 3. You execute this before your conversion, not after. For self-employed individuals, the solo 401(k) solution is often the best approach. A solo 401(k) allows both employee deferrals and employer profit-sharing contributions, with much higher contribution limits than a SEP IRA. More importantly, it allows in-service rollovers. Here's a walkthrough. A self-employed consultant earning $200,000 per year has been funding a SEP IRA, which now holds $180,000. She establishes a solo 401(k) and rolls the $180,000 into it. She then contributes $7,000 to a new traditional IRA and converts it immediately. Because her IRA balance is now $7,000, with the SEP rolled into the 401(k), the entire $7,000 conversion is non-taxable. The tax savings here are substantial. Without the rollover, she'd owe approximately $4,680 in taxes, assuming 67% of the $7,000 is taxable at a 45% rate. With the rollover, the tax is zero. But there are important timing considerations and documentation requirements. You must execute the rollover before the conversion in the same calendar year. You need to keep detailed records of which assets came from the rollover and which are the new contribution. And if you mess up the timing, the IRS will assess taxes retroactively with interest and penalties. Another important consideration: state taxes. Some states like California tax Roth conversions as ordinary income in the year of conversion, even though the IRS allows deferral. This can create a situation where the federal tax is spread over multiple years, but the state tax hits all at once. For $50,000 conversion in California, this can add an extra $9,500 in state taxes on top of federal liability. Let's also address who's affected by this trap. The pro-rata rule overwhelmingly impacts 1. Entrepreneurs and self-employed individuals who have accumulated SEP IRAs or Solo 401(k)(s)(2), early retirees who have rolled over multiple 401(k)(s) into ERAs 3, corporate employees who have accumulated traditional IRAs from previous employers 4, dentists, doctors, and other high-income professionals. According to data from the National Institute on Retirement Security, the average high-income household has approximately $287,000 in pre-tax retirement savings across multiple accounts. That's a substantial pro-rata trigger. In conclusion, the pro-rata rule is one of the most misunderstood aspects of retirement planning for high earners. A $50,000 conversion can easily cost $15,000, $20,000 in taxes if you're not aware of this rule and don't plan accordingly. The solution requires either rolling pre-tax IRAs into 401(k)(s) before converting, or finding alternative accumulation strategies that don't create IRA balances in the first place. The best time to address this is before you accumulate the pre-tax balances during your peak earning years, when you still have